Now, another consequence of high inflation is its impact on our international competitiveness. Now, we know that we don't exist in a closed economy, and so international competitiveness refers to how competitive our exports are on the international market. And this is very much determined by our exchange rate. And our exchange rate is how much our currency is worth in terms of another. But we'll go through that in another lecture. But now we're just going to focus on how high inflation can in fact affect our international competitiveness. So how we compete with exports of another country. Okay, let's look at a working example of this. Let's look at the market for wheat. And as we know, we have Australia and we also have New Zealand selling wheat. This is a market for wheat. And as we know, wheat in Australia and New Zealand are perfect substitutes for each other, and wheat is a homogeneous good. We're going to assume that there are no quality changes or differences between Australian wheat and New Zealand wheat. The exchange rate for Australia and New Zealand are as follows. So we're both trading to the USA. So they both want to trade to the USA. So the USA wants wheat. So the exchange rate between Australia and USA is 1 USD can buy, say, 2 AUD for simplicity reasons. As we know, the current exchange rate is around 90 to $1.10, but that's a little bit more complicated if we use that. So we're just going to assume that Australian dollar, or 1 Australian dollar can buy 50 US cents, or 1 US dollar can buy $2 Australian. And similarly, you can say 1 US dollar can buy 5 New Zealand dollars, also for simplicity reasons. Now, initially, we're going to assume that the price of wheat in Australia and New Zealand are exactly the same. So, in Australia, that would be, say, 20 AUD, and in New Zealand, it would be 50 New Zealand dollars, say, per kilo. And of course, these numbers are totally hypothetical. And of course, we know a kilo of wheat would not cost $20 or $50 US, or New Zealand, I mean. Okay, so what this means is that if we change the exchange rate and we change this back to US dollars, it'd be 10 USD per kilo. And similarly here, if you divide this 50 by 5, you get also 10 USD per kilo. And because the good is homogeneous, the US can either buy from Australia or New Zealand and get the same price for a kilo of wheat. But let's see how inflation can actually affect the price of wheat. Let's say Australia's inflation rate is 10%. So this basket of wheat would then increase to $22 AUD per kilo. And since New Zealand's inflation rate, what we're going to assume is 0%, a kilo of wheat would stay the same at $10 USD per kilo. However, if we're assuming the exchange rate for Australia and the United States stays the same at 1 to 2, we can see now that the price of wheat in US dollar terms has now increased to 22 divided by 2 equals $11 USD a kilo. And so what happens here is now we can see that $11 is obviously greater than $10 in New Zealand dollar terms. And so what the USA would do, assuming that the wheat is homogeneous and they could either trade from New Zealand or Australia, the USA would then have to buy, or then prefer to buy, the New Zealand wheat as opposed to the Australian wheat, which is more expensive at $11 a kilo for them. And so what this means is our exports would go down. So exports will fall. And this is a very bad thing in the economy because a lot of our jobs are secured in the export market. And so what happens when exports fall? Let's rub this out. So what happens when exports fall is that a lot of jobs will be lost and income will be lost in the economy, and therefore aggregate demand will fall. So now, as we can see from before, when we see that exports will fall, so when inflation increases, now exports will fall because they are less competitive, as we saw in the wheat example. And what happens now is that our aggregate demand will fall, and therefore incomes will fall. And because exports, we talked about how exports, the export sector holds a lot of jobs, employment will also fall. And now, if you go back to the circular flow model, you can see how a change in inflation can affect not only our international competitiveness, but also affect the entire economic sector as well. So we can see how a decline in exports would actually cause aggregate demand to decrease, income to decrease, employment to decrease, and therefore even worsen, possibly even worsen, confidence. And this triggers a vicious cycle of economic activity where everything falls and our overall living standards decrease. So we can see how high inflation can ultimately cause a decrease in purchasing power plus a decrease in our living standards.